And hopefully we're also a lot closer to making some money on these mining stocks. I mean, that's, you talked about that on the introduction, and I've been investing in these names for a long time. We're recording this podcast. Gold is close to 2,600. Quite a bit higher than it was years back. But we haven't made a lot of money in the mining stocks yet. But I think that the prices we're seeing now are still very low. I think gold has a long way to go to catch up to where it should already be. And I think when it really starts to move, it's going to get there in a hurry. And so I think that's going to reward the people who, moved in advance. I mean, I think it's, a great opportunity that people who never even bought any gold stocks can buy them now and make, almost as much money as the people who bought them 10 years ago, maybe more. Mm-hmm. But they didn't even see it coming far in advance. But at this point, it's kind of obvious. Everybody should be able to see this.
And do you think part of the sentiment shift towards gold, because I'm seeing it too, and there's a handful of factors that drive price, obviously not just one thing, but more people are starting to ask questions about why prices are rising. A lot of people will still buy whatever narrative they're sold. If it's a Democrat leadership, they'll buy price gouging. If it's Republicans, they'll buy immigration as the narrative instead of just accepting that it's monetary inflation is just more currency. But I think as more people ask the question, why are prices going up? Why are we running such extraordinary deficits? There's a sentiment shift towards hard assets. And that's probably one of the core reasons that we're seeing people turn their head that direction. Do you think more of that is what will drive the gold narrative, Peter? Or what lands on your desk when you think of people shifting their attention to hard assets and precious metals?
Yeah, I don't think most people have already shifted their attention, at least not in the West, certainly not in the United States. Interest in gold is still relatively low. I mean, you would think that the phones were ringing off the hook at my gold business at Schiff Gold. It's business as usual over there.
Really?
There's no media attention. I mean, sometimes I go on CNBC on days that gold makes a new record high, and they don't even mention it. And I'll see the gold mining stocks and silver stocks as the best performing sector. And when they go over the sectors that did well that day, they don't even mention precious metals mining. So it's not getting any media coverage. The public is really not there. In fact, the public has been net sellers. Look at the GLD, the big ETF. They've had net liquidations all this year. So the public is getting out of their gold, even though the price is going up. We know the economy is weak. I'm sure jewelry sales are down, so people are buying less gold jewelry.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galiano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
So, why is the price of gold going up? Because central banks are buying it, and they're not the dumb money. These guys are making decisions, calculated decisions, as to what asset they want to hold. And they're mainly choosing between US dollars and gold. And they're foregoing the interest they can earn on those dollars, and they're buying gold for a reason. Right? They know what's going to happen to the value of the dollar because the deficits are in the process of going ballistic. We're adding now $3 to $4 trillion a year to the national debt. And that's going to accelerate during the next recession, which may have already started. I've been arguing we've been in a recession for some time now. It's just that the official statistics don't acknowledge that fact, but they may be revised to admit it at some point. But that's probably one of the reasons that the deficits are skyrocketing. In fact, we just got the I think it was the July deficit or the August deficit came out last week. And it was the biggest August ever, including 2020 for 1 month. So the fiscal, position is deteriorating rapidly for the United States, and that's probably because the economy is much weaker than the statistics. And that's why the government is not collecting enough in taxes, and its expenses are going up. So, I think the dollar's days are numbered. I mean, look at it. It's, almost, it's at a 13-year low against the Swiss franc. No one really talks about that. But, we're close, about 7% below an all-time record low for the U.S. dollar versus the Swiss franc. The dollar had been strong against the yen, but that's reversed recently, and the yen is trading at near its highest level of the year now. So that we're starting to see cracks in the dollar. I mean, maybe once the Fed cuts rates tomorrow, and it's a foregone conclusion they're going to cut, all they're arguing over is the size of the cut. Is it going to be 25? Is it going to be 50? I don't even think it matters in the scheme of things. Any cut is a mistake. The Fed should be hiking rates. They never should have stopped hiking. They only did it because banks started to fail. And the reason they're cutting now is because the economy can't handle these rates, even though they're actually low. Rates never got high. That was just a lie. The Fed never got to restrictive territory. You know that because a savings rate is at a record low. Credit card debt, household debt's at a record high. That is a sign of easy money, not tight money. When the Fed is restrictive, people save. They stop borrowing, right? But the government's cut back on their spending when the Fed is restrictive. The Fed never got the government to do anything, but they just kept on borrowing and spending as if interest rates were still at zero. They haven't cared. So the Fed hasn't moved the needle at all on demand, really. And so inflation is still a big problem. But when they start cutting rates tomorrow, it's going to reaccelerate inflation to the upside, which has been basing now over the past year officially at about 3%, which means unofficially it's probably 5 or 6%. But then once they go back to the rate cuts, I think that it's only a matter of months before they go back to QE, because I don't think the rate cuts are going to work. I think the economy is going to keep weakening. And what I think is also going to happen is that long-term interest rates and mortgage rates might actually go up after the Fed cuts rates. And now what's the Fed going to do? Because that means the lower interest rates aren't helping Americans who are borrowing. We know credit card rates are at a record high right now. They're not going to go down when the Fed cuts rates. Why? Because delinquencies are rising. The credit card companies can't cut rates. Doesn't matter to them. When they're charging 20%, doesn't matter if the Fed is 5% or 4%. That's irrelevant. Their interest rates are a function of losses of the people who don't pay. That's what they have to get from the people who pay all the losses from the ones who don't. And more people are not going to pay their credit card bills because they're broke. So credit card debt, I don't think you're going to see much of a reduction in auto loans. I don't think we're going to have any real reduction in mortgages. But even if the Fed cuts mortgages, it's not like even if mortgage rates go down, it's not like we're going to have a big wave of refis. Because even if they go down, they're not going to go down low enough to let people refinance because everybody's already got a rock bottom mortgage. So they've already, played that card. They don't have it again. So this is going to be a brutal recession, but the Fed is going to go back to QE, and that's what's going to reignite inflation. The dollar is going to tank, and then gold is just going to go ballistic. And we've just seen, the tip of that iceberg as far as where gold's going to be.